This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and have a look at the world of cash flow hedge accounting. In the previous videos, we went through and looked at the general concept of how hedge accounting worked. And it looked something like this, didn't it? We had a hedging instrument, so usually a future that protected an item against a specific risk over which we were concerned about. So whether that was an increase in price, whether that was a reduction in price, it will all now start to become a little bit clearer as we start to look at the different types of hedge accounting. As I said, this video is going to go through there and focus first of all upon your cash flow hedge accounting. And when you're looking at your cash flow hedge accounting, the key bit that determines that it is cash flow hedge accounting is by looking at the hedged item and looking at the particular type of risk that you are faced with as well. When we look at the hedged item, the issue that we have here is that we are trying to protect against changes in future cash flows, usually when it comes to buying an asset. So what we have there is that if there are any future purchases of assets within the business, so if you're an airline industry and you are looking to protect the future purchase of jet fuel, then you will be entering into a cash flow hedge because you are trying to protect the value of that future cash flow. You are concerned that the price of jet fuel will rise. If the jet fuel will rise, it will make it more expensive and that will reduce your margins, won't it? So what we want to try and do is to try and fix a price on that jet fuel so that if the price of jet fuel increases, then we just pay the agreed amount that we have within our future. Okay. So what have we got? Let's just look at the specifics. I think key bits that you need to pull out in terms of the rules from the standard. And I think these rules are there within your notes. First of all is that future cash flow needs to be highly probable. So more likely than not that it will arise. You know, if you're an airline business, I think it's more likely than not that you will purchase some jet fuel. They don't just fly without jet fuel. They need plenty of it within there. And also what we usually see is that it is trying to protect a price rise before we buy that item. Okay, just be careful. Again, that's usually the case. We could be trying to protect that highly probable future cash flow if we are looking to sell something in the future, in which case we will be looking to protect it from a price fall. But the majority of questions that we see, the majority of scenarios that the businesses enter into cash flow hedges for are for your future purchases, your highly probable future cash flow. So therefore, we will look at it and address the fear, if you like, that the price will rise. Okay. If that's the case, we need to look at hedge accounting. So remember, hedge accounting goes against all the usual rules that you have within IFRS 9 to deal with financial assets, to deal with financial liabilities, to deal with derivatives. We are looking at our own separate, unique set of rules. Okay, so what we need to account for under hedge accounting is we need to account for the instrument, which is usually the derivative, so the future, and we also need to account for the item. So here, the highly probable future purchase, and on both there will be gains or losses, won't there? And hopefully there'll be an accounting matchup from our hedge accounting whereby the gains and losses offset each other. The issue that we've got here is when we look at the item, the future purchase, nothing's happening. It's not recognized within the accounts, is it? So there's not going to be any gains or losses just yet on that item. So when, therefore, there are the gains and losses on the instrument which we've entered into to protect the increase in value of the item, where are we going to take those gains and losses? You know, it's a derivative. Normal derivative IFRS 9 treatment says take it to profit or loss, but we're cash flow hedge accounting. So the gains and losses here are recognized in other comprehensive income. If we look at the really picky rules, which we'll see more detail in later videos, it's the effective element of the hedged instrument and the gain or loss on that hedged instrument that goes to other comprehensive income. If it's slightly ineffective, so if the gains and losses don't offset each other exactly, then some of the gain or some of the loss we'll have to go through profit or loss. But for the time being, let's just take the gains and losses on the hedged instrument to other comprehensive income. We'll worry about effective ineffectiveness later on. What then happens is you get this storing up of the gains or losses in a hedged reserve in other comprehensive income. And what we then do is when that item is recognised, maybe we end up paying more for it than what we originally thought because prices have risen. So there will therefore be a loss on the item. There will therefore be that gain that's being stored up in OCI, and that gain is then recycled through to profit or loss that offsets the losses on the higher, more expensive purchase, and therefore hopefully netting it off to the price that had been agreed with in our future. Okay, complicated. Let's have a look at it with a bit of an illustration. Hopefully we can piece it together and help you along a bit further. So what we've got, remember, we're going against all the usual rules of IFRS 9. We are looking now, aren't we, at IFRS 9 and hedge accounting. We have an illustration here that will allow us to look at the hedge accounting for the instrument, the future, and the item, which here I think is the future purchase of 1 million oranges in 3 months' time. Okay, we're told that those oranges are there at $0.2 million. The weather might mean that maybe there is not so good a harvest. Therefore, that means there is fewer oranges out there for the market, which will drive the price up. That's our main concern, isn't it? Okay, that it's so hot over there in Spain that there's not enough water to be able to irrigate the oranges on the farm, and therefore there are fewer oranges in the market, and therefore it is more expensive in the future. That's our risk. So we're worried about the prices increasing, and from a cash flow hedge perspective, we're trying to protect the price of a highly probable future transaction. I'm an orange juice manufacturer, so I need oranges. Okay, so it is highly probable that I will be buying these oranges. So what I do is I enter into a futures contract, the settlement in 3 months' time at $0.2 million. That's what I'm trying to protect the value of these oranges at. So what happens with regards to the accounting? Let's first of all look at it whereby there is no hedge accounting. Okay, so what we've got there is we've got the futures contract and the future purchase of oranges. Okay, so on the futures contract, if there's no hedge accounting, the gain or loss will go through profit or loss at each reporting date to profit or loss, won't it? Okay. On the future purchase of oranges, we just buy the oranges when we need them at some point in time and pay market value. Okay. The issue that you've got there is there's an accounting mismatch, isn't there? You know, if the price of oranges on the market is going up, then what will be happening is we've gone through there and placed a bet on our fear that the price is going to rise. As we've placed a bet on our fear that the price is going to rise and the fear is actually materializing, then we will be generating a gain on the future, won't we? And by taking that gain to profit or loss, it looks really good, doesn't it? Okay. You've got this nice big gain going through profit or loss. That puts up your profit, puts up your earnings, puts up your earnings per share. It all looks rosy from the company perspective and good for the shareholders, doesn't it? However, that derivative is not there for speculative purposes, is it? That derivative is there, that futures contract is specifically there for hedge accounting. So we want to get rid of that accounting mismatch. We don't want to see the gain or loss through profit or loss, and that is why we then look at cash flow hedge accounting. Instead of taking the gain or loss to profit or loss, we're now going to take the gain or loss to other comprehensive income. Profit or loss, OCI at the bottom, just hiding it out of the way so it isn't seen there within your profits and there within your earnings. Okay, so what happens? Well, look, we are now going to look at it as hedge accounting. So we have a futures contract and the future purchase of oranges, don't we? The futures contract is the hedging instrument. It's important that you identify that in an exam question. The future purchase of oranges is the hedged item. And within hedge accounting for a cash flow hedge of a hedging instrument and a hedging item, you need to know the rules. For the item, you just recognize it when it is bought at some point in the future. So within the financial statement, there is nil, zero, de nada, nothing, okay, within your accounts. However, we need to look at the hedging instrument, don't we? Where do we now take the gains or losses on the hedging instrument within a cash flow hedge scenario? Where? No, not profit or loss. Where else? Excellent. Other comprehensive income. Yeah, we've designated this future as the hedging instrument. So therefore, within a cash flow hedge, again, we'd need to document that it is a cash flow hedge. We can't just chop and change between cash flow and fair value as you so wish. No, it has to be designated. It has to be documented. And the gain or loss at each reporting date will go through other comprehensive income. We're storing up any gains or losses within reserves, aren't we? Okay, and then what happens there is that is then recycled, isn't it, through profit or loss. Okay, so if we go through there and just advance the example just a little bit in terms of, let's just say that the price of oranges under hedge accounting increases to 0.25 million at the reporting date. Okay, what happens? Okay, so we're looking at the accounting at each reporting date. Well, here goes. In terms of the future purchase of oranges, still haven't bought them. Okay, we're going to buy them in the next accounting period. So we haven't recognised our oranges, have we? No. However, if we look at our futures contract, we've got a futures contract that allows us to buy the oranges at $0.2 million in 3 months' time. Okay, maybe a little bit less than 3 months' time now because we're now at the reporting date, but let's just say in the future. So we've got a contract piece of paper that says you can buy it at 0.2 million. On the market, the 0.25 million. Would you sooner buy it on the market at 0.25 or with my piece of paper that says 0.2 million? Yeah, my piece of paper, the $0.2 million futures contract. That futures contract has some benefit. It's cheaper with the contract than without. So therefore, I have a gain on that contract, don't I? A gain of 0.05 million. Okay. If you want, you can just quite simply look at it in another perspective and say, well, look, the market price has gone up. It will therefore be more expensive. So therefore, there is a loss on the item. If there's a loss on the item, there must be a gain on the future. Okay. Or alternatively, you can just look at the futures contract and say it is cheaper with the contract than without the contract by the tone of 0.05 million. So what happens is the 0.05 million gain goes there through other comprehensive income because that futures contract under hedge accounting for cash flow hedge accounting is there as your hedging instrument. The gain or the loss, but here it's a gain, goes through other comprehensive income. Okay, scurried away in your hedge reserve. Okay, excellent. So let's just see what then happens when we close out the futures contract and when we buy the oranges. So let's just say shortly after the reporting date, we then buy those oranges at the 0.25 million. We'll keep it simple. And let's just say there's been no change in the market price of oranges. Okay, so we buy the oranges, don't we? We buy them at the $0.25 million. Okay, what's now happened is there's been no change in the value of the futures contract. It's still there as a financial asset on the SFP at 0.05 million, and the gain is stuck there within your hedge reserves within other comprehensive income. What now happens, as you can see on the left hand side, is there that gain is recycled through, is it there to profit or loss? Okay, so when you take that gain to profit or loss and match it up against the more expensive purchase of your oranges, if you net off the 0.25 million expense with the 0.05 million gain, they net off to the $0.2 million cost of oranges that we were trying to protect. Okay, that's it. Yeah, we have fixed the price at $0.2 million. Okay, you can put in whatever numbers you want. I've used 0.25, you could use 0.3, 0.4, 0.45. You could even, I challenge you, to see what happens if the price of oranges actually goes through and falls. Okay, that would see if you fully understand hedging, because therefore what then happens is that you have a gain on the item as it is cheaper to buy the oranges, but therefore you have a loss, don't we, on the instrument. But that's giving it away too much. Okay. The other point to note just from this illustration is that this hedge is just 100% effective. Okay, there is no ineffectiveness within it. Let's not talk about effectiveness, ineffectiveness, because that just complicates it. Okay, we are assuming that it is a 100% effective hedge. Okay, everybody happy with what we have there? Okay, excellent. In terms of the scenarios that you're keeping an eye out for, I think these are listed within the standard as well. Cash flow hedge examples. Remember, you're looking to protect the highly probable future cash flow. So here you're entering a commodity future to hedge against a highly probable future purchase or sale of the commodity at a future date. So here the commodity was oranges. You were looking to buy the oranges in the future, and it was highly probable. The other one, jet fuel, with an aeroplane company looking to purchase that jet fuel at some point in the future. Okay, again, you are worried if you are purchasing about the rise in the value of that asset when it comes to purchase. If you're looking to sell it, and the concern is that there is a fall in the value, but I'm not too worried about that there. And then the other one to keep an eye out, I think it may have been seen in an exam at some point in the future. If only I knew, that would be grand, wouldn't it? At some point in the past, I should say, is that maybe you enter into an interest rate swap. And this is where I think it just gets a little bit unfair, because when you talk about interest rate swaps, that's more of a P4 area, isn't it? I think you brush upon it briefly within F9. But what you've got, interest rate swap, is you try and negotiate with a counterparty who also has a loan as well, so that what you can do is that you can end up with your current loan with a cheaper rate of interest. Okay, so if you're currently paying 5%, maybe you'll pay 4.5%, 4%, however it works. Okay, it's all to do with the rules of comparative advantage and things like that, but that's more of a P4 issue. Key bit, let's just think about it, P2, and what we're looking at. An interest rate swap is very literal. So you swap the interest, so you have a future cash flow. Okay, it's a highly probable future cash flow. So therefore, the risk might be that that cash flow increases, which could happen if you have a variable rate loan. Okay, if the rate goes up on your variable rate loan, there will be a higher cash flow in the future. So what you might do is you might enter into an interest rate swap to try and fix that rate of interest. Okay, so do just be aware, if you enter into an interest rate swap on a variable rate loan, that will be there as your cash flow hedge. Okay, keep an eye out for them. You might see them in exam questions. Where have these things appeared in exam questions? There has been a tiny bit of hedge accounting in the past within a group profit or loss and other comprehensive income question. Whereby, if memory serves me right, you were quite simply just told there was a gain or a loss on a hedging instrument in a cash flow hedge. Simple. You just put that gain or loss within other comprehensive income. Okay, and within other comprehensive income within that section, whereby it will be reclassified, okay, to profit or loss. So that's a numerical example. They didn't even ask you to calculate the gain or loss. I think most people just took the figure given and threw it into OCI within items that will be reclassified to profit or loss. If memory serves me right, I don't think it's been seen within the statement of financial position. Could be, because when you're accounting for the instruments, you know, you're going to have a gain or a loss that will go through the reserves. So an other components of equity reserve, if you like, your hedge reserve. And then you've got the other side of the entry, haven't you? Either the financial asset or the financial liability. So it could appear within a group SFP question. Given it appeared in a profit or loss and OCI question, you'd think that the chance of it appearing would be fairly likely. I wouldn't say the word's highly probable, because that's just a bit too corny, isn't it? But it's going to happen at some point in the future. It's obviously appeared within question 2 and question 3 in terms of a focus question or a mixed question. If you don't like hedging, Don't do that question, okay, with the simplest solution. And I think as well there has been a tiny little bit within a current issues question, just a tiny little aspect in terms of where it gets you to do a bit of application at the bottom of your current issues question. Again, it was just a little bit of hedging, okay. So you'll see those examples, you'll see those questions as you work through the material. Other than that, that's it for now with regards to hedging and your cash flow hedge accounting. See you later.